Welcome back. Central banks around the world, and most importantly, perhaps the U.S. Federal Reserve, continue to hike interest rates in an attempt to fight inflation. Our next guest believes the key for investors is understanding the frequency and magnitude of these rate increases from the Fed. For more, let's bring in Robert Gill. He's Senior Vice President and Portfolio Manager at Goodreid Investment Counsel. Robert, welcome to the program. Thanks a lot for being here. This is your first time as a featured guest. We're delighted to have you with us. You brought a graphic with you, and we can bring that right up now and get you launched on your conversation. And it shows, in short, the white line is the most recent path of Fed rate increases, and it shows us that this has been the steepest path of Fed rate increases in recent memory. Why don't you take it from there?
Great. Thanks very much, Paul, and it's a pleasure to be here, always. The world right now, as we know, is grappling with the highest interest rates that it's seen in decades. Prices of everything are higher, from groceries to gasoline to new and used cars. In order to combat inflation, central banks are raising interest rates. And so I think the key point this time around is that both the frequency and the magnitude of these rate increases are particularly unique. And so in order to see just how unique the situation is, we need to take a look at some other rate hiking cycles in recent history. And this chart is a great example. So let's take a look here. On the horizontal axis, we have time, and on the vertical axis, we have the percent change in interest rates. Now, if we take a look at the 2015 to 2018 time period, which extends off to the right, you'll see that this represents a period of gradual interest rate increases over a longer period of time. These were the first interest rate hikes coming out of the global financial crisis, which I'm sure many of us will remember as being quite a nasty period in financial history. The Fed chair at the time was Janet Yellen, and she increased rates by just a little over 2%, and the duration was 35 months. So that's just short of about 3 years. These hikes were more gradual in nature, and the reason for this was that the economy was experiencing very low inflation at the time, and there was a slow recovery coming out of the global financial crisis. The key takeaway, though, is that this was a very different set of circumstances than what we have today, and it called for a very different policy response from the central bank. And
so the Fed has been much more abrupt in dialing rates up in a big hurry, and talk to us about the market reaction to that. This has come as a shock to the market.
Yes, absolutely. So if we take a look at 2022, that's the white line that you can see on the far left-hand side of the chart. You'll see that under the current chair, Jerome Powell, the current line on the chart is by far the steepest. So it means that rates are rising faster than at any point in time in recent history, as you can see from the chart. You'll see that rates have increased by 3% already on a period of only 7 months. So what's next? Well, we believe that more interest rate increases are likely. We saw that earlier this week with the Bank of Canada raising rates by 50 basis points. Sorry, go ahead, Paul. We
hear the word pivot a lot from investors these days, perhaps optimistically, forecasting that eventually the Fed will pivot to either halt interest rate increases, or if the U.S. economy is indeed tipped into a recession, to start cutting rates in a move to stimulate the U.S. economy. Does the faster pace of rate increases suggest that a pivot may come sooner rather than later?
Well, that's an excellent question. I think what the central banks have been trying to do, if you listen to the rhetoric, is they've been trying to front-end load a lot of these rate increases, which means that really they're applying the brake quickly at the beginning of this situation. And so the faster the rate increases that we have, the quicker we'll get to the point where we're going to be able to take our foot off that brake. What we don't want to happen is what happened back in 1980 and 1981, and there we had some rate increases, but we eased off the brake a little too quickly. It put the economy into a recession, and then we had to go through another period eventually we came out of that recession with some exuberance, and then we had to increase rates again, and so we ran into recession again. We don't want a period like that, so we've got to be very careful.
Okay.